Gold just hit the kind of price zone that makes the $SS all clear narrative sound like background noise. And the truth isn't that even in the headline print, it's in the way the market is pricing time. Because right now, the dollar is sliding into the weekly open and gold flows are rotating fast. And the part that matters isn't gold up, dollar down. The part that matters is what the curve, the spreads, and the positioning are forcing people to do when liquidity is thin and the first real orders of the week have to show their hand. And later in this video, I'm going to give you the only checklist you actually need for the next 1 to 2 weeks, the levels that matter. What would confirm this move, what would break it, and the specific tell that tends to show up before the move turns into a squeeze. But first, you need to understand why the open is where the trap springs. The weekly open is not a neutral reset. It's a stress test. Dealers come in and rehedge, funds rebalance. Asia hands off to Europe, Europe hands off to New York, and each handoff changes the liquidity profile. Spreads widen, depth thins, and price discovery becomes less about fair value and more about who is forced to transact. That's where the real pressure starts. Because if you think the market is always liquid, you're going to misread the whole move. Liquidity is a mood. At the open, the mood changes fast. If you have ever watched gold on a Monday and felt like it either drifts like it sedated or snaps like someone yanked the cord, that's not magic. That's market structure. And when the dollar is already leaning lower into that moment, when the US dollar index is hanging around the high 90s area instead of flexing, gold doesn't ought to need a dramatic macro headline to get a bid. It just needs one thing, for the dollar to stop being the automatic winner. But that's not the part that matters. The next detail is what flips the whole setup. People stare at spot. Pros stare at the relationship between contracts, the cost of carry, and the urgency embedded in the curve. That's why I'm telling you the price can lie, but the spread tells the truth. When gold is in a normal, well-supplied state, the curve tends to reflect the cost of holding metal, storage, insurance, financing. That usually means a gentle contango, front month a bit cheaper than later months, because time costs money. But when something shifts, when the front end tightens, when nearby pricing gets stubborn, when the curve flattens more than it should, that's not vibes, that's inventory math. And inventory math doesn't care about your opinion. It cares about what can be sourced, what can be delivered, and how much balance sheet is available to intermediate the difference. This is the hidden detail most people miss when they talk about gold like it as purely a macro meme. Gold is macro, yes, but it's also a deliverable commodity with a paper layer wrapped around it. And when the paper layer starts to feel friction against the physical layer, it shows up first in spreads, lease dynamics, and where the bid is along the curve. But here's the key. You don't need to claim cartoon manipulation to understand the incentives. You just need to understand how the machine behaves under stress. If you're a dealer and you're short optionality into a rising market, you don't get it to wait and see. You hedge. If you honor a fund and your model says dollar weakness plus falling real yields equals higher gold beta, you don't write a think piece, you buy. If you're an industrial participant or a refiner and you see localized tightness, you don't tweet it. You pull metal forward. And if you are a short who pressed the trade because you assumed rate cuts are delayed or risk on will kill gold, you can be right on the macros and still get forced out by the mechanics. Because if this one level breaks, the math changes. Now let's talk about what we can actually see right now without pretending we have omniscience. Gold has been trading in the mid 4,000s per ounce area in recent January prints, pushing into fresh record territory around the upper 4,600 zone in some sessions, after starting the month closer to the low 4,300s. That's not a normal drift, that's a regime. It is the market repricing the role of safe assets in a world where uncertainty doesn't T-resolve, it just rotates. And on the other side, the dollar, rather than ripping higher, has been living closer to the high 90s area on the DXY measure in recent reads. Not exactly the posture of a currency that's about to squeeze every commodity lower. But here's the trap. A weak dollar does not guarantee a straight line for gold. It just changes the baseline friction. Gold can whip around violently even if the thesis is correct. That's not a disclaimer, that's a feature of this market. Gold is where people go when they're uncertain, and uncertainty trades like a heartbeat. Fast, spiky, emotional. And that's exactly why you need to focus on mechanisms, not moods. Because when you see gold flows rotate fast at the open, what you are really watching is a rotation in who is providing liquidity and who is demanding it, right when the market is most sensitive. And that sensitivity is amplified by the calendar. The calendar is the catalyst. We're in January, and January is where a lot of institutional behavior resets. New allocations, new hedges, new budgets, and most importantly, new option books and new rebalance cycles. Then you layer in the simple truth that month end is always a forcing function for funds that track weights, vol targets, or systematic signals. Add a weekend gap, Add a thin open, add a market leaning the same way, and suddenly small flows have big consequences. That EOS when the paper market can get vetoed by the supply chain, not because someone flipped a villain switch, but because the marginal ounce becomes expensive to source at the margin, and the curve starts to admit it. But wait, because the easiest mistake is to assume this is all physical tightness and ignore the other accelerant. Options, reflexivity. Dealers don't trade opinions, they hedge math. If gold has been climbing and it pushes through a major strike cluster, think big round numbers, recent highs, and the pain points where a lot of calls were sold, the dealer community, as hedge requirements, can flip from passive to urgent. Here's the clean version. When traders buy calls, dealers often take the other side and hedge by buying futures or spot exposure. The amount they need to buy depends on delta. As price rises, delta rises, and if gamma is high near the strike, delta changes fast. That means the dealer has to buy more as price rises, which can push price higher, which forces more buying. Reflexivity, not mysticism, math. And the open is where that math gets refreshed. Positions roll, hedges get adjusted, books get cleaned up. If the market gapped, the hedges are wrong until they're fixed. That SYU, I'll see these sharp bursts right after the open where it looks like gold decided to run. It didn't decide. Someone's hedge requirement changed. And if the dollar is sliding at the same time, it lowers the resistance. But that still isn't the whole story, because the move is also being fed by global arbitrage. Gold is a global asset, but it is not always priced identically everywhere once you translate through FX, local premiums, and logistics. If gold is effectively cheaper in one region after you adjust for the currency move, the arbitrage chain wakes up. Someone buys where it's cheap, sells where it's expensive, and that pull drags the global reference price. When the dollar weakens, that translation changes. Gold priced in euros, yen, yuan, rupees. Those moves matter because they change local demand behavior and the incentive to move metal. And that matters this week because arbitrage is not a theory. It's a set of actions. It's shipping schedules, refining capacity, collateral, and credit lines. It's also about what qualifies for delivery in the places that anchor price discovery. Deliverable inventory is not the same thing as total inventory. There are categories. There's metal that exists but is committed, and metal that can actually be delivered against a contract without someone paying up to liberate it. And that's where the real pressure starts, because the paper market can quote infinite liquidity until the moment someone asks, cool, deliver it. Now, I'm not here to pretend we can see every vault in real time or name every flow with perfect precision. That's not necessary. The point is to triangulate, to proof stack, because one argument is a story. 5 arguments that align is a signal, so let's stack them. First proof point, behavior at the weekly open. If gold is catching a bid early, especially when liquidity is thin, that tells you demand is not waiting for better prices. That's urgency, hedging, or structural buying. Second proof point, the dollar's posture. A dollar index hovering around the high 90s range rather than ripping higher reduces the headwind for metals priced in dollars. It also signals that the market is at least entertaining a softer dollar regime, even if it's choppy. Third proof point, the curve and nearby tightness cues. You don't need to claim full backwardation to understand that when front-month pricing acts too strong relative to carry, the market is signaling something about availability, financing, or hedging urgency. Fourth proof point, institutional rotation. This is where people get lazy. They wait for a headline like ETF inflows surge, and by then the move is already halfway done. Institutions rotate through multiple pipes, futures, options, OTC, and allocations. Even a small shift in portfolio weight, 0.5% here, 1% there, can move a market that's already tight at the margin. And in a year where uncertainty remains sticky, gold doesn't need everyone. It just needs the marginal allocator to keep bidding. Fifth proof point, cross-market confirmation. Watch not just gold, but silver-gold, silver ratio behavior, and how gold trades in other currencies. If gold is making new highs in dollars, but also staying firm in stronger currencies, that's not just USD translation. That's a broader bid. And you've seen silver acting like it wants to join the party at times, sometimes explosively. Because once precious metals momentum flips, the whole complex starts to feel that paper versus physical tension differently. Now, let's address the counterpoints before you get emotionally hijacked by the most bullish version of the story. Because the fastest way to get wrecked is to treat a strong setup like a guaranteed outcome. What could break this? A sharp dollar squeeze is the big one, and dollar squeezes don't require the dollar to be fundamentally strong. They require positioning to be wrong. If the market is leaning short dollars or long metals, a sudden risk-off shock or a policy surprise can cause a scramble for dollars, not because the dollar is beloved, but because it's the world's collateral language. In a squeeze, Dollars get hoarded, funding costs spike, and assets that should benefit from uncertainty can still get sold temporarily because people need liquidity. Another counterpoint is the rate narrative whiplash. If the market is pricing a path of easing and suddenly the message shifts, maybe a Fed speaker leans hawkish, maybe inflation prints reaccelerate, maybe growth surprises upward. The front end of rates can move, real yields can pop, and gold can take a hit even if the longer-term thesis holds. And there's a third counterpoint that trips up a lot of people: the difference between trend signal and noise. In a bull regime, gold can drop a lot in a week and still be bullish. It can also rally hard for 3 days and still be a bull trap if it loses the key level and fails to reclaim it. That's why we have to talk about levels in a way that respects volatility, not as magic lines, but as zones where behavior changes. Because if this one level breaks, the math changes. Let's talk levels, but keep it real. In this kind of regime, the most important level is usually the most recent breakout zone that flipped from resistance into support. If gold has been printing in the upper 4,600s area and flirting with record highs, then the zone just beneath that, call it the mid 40 hours and 500s to high 40 hours 500s region, often becomes the first battlefield on a pullback. Below that, you typically have a second shelf where the market consolidated before the run, think mid 41 to 100 alerts. And below that, the earlier month's base in the low 4300s area becomes the if we lose this, something changed zone. Don't get hypnotized by exact numbers. Get hypnotized by behavior around those zones. Does the dip get bought quickly? Do spreads stay firm? Do opens gap up and hold? Does the market reclaim after a flush? That's what matters this week. Now, let's get to the core claim in your title. Dollar slide. Alert, gold flows rotate fast at the open. The conflict is simple. There's a persistent narrative that gold is too high, overbought, due for a correction, and that the dollar will eventually reassert itself. And you might even agree with pieces of that. But the hidden mechanism is that flows and hedges don't wait for narratives to be resolved. They move when the math says move. If the dollar is sliding and gold is holding firm at the open, that tells you something about who is defending price. It suggests that dips are being treated as inventory opportunities, not exit ramps. And that's a very different market than the one where rallies are sold and weakness is feared. But that's not the part that matters. The next detail is the why now calendar trigger. You're not just dealing with a macro theme, you're dealing with January mechanics, systematic reallocation, new option positioning, and the approach of key expiry and delivery windows. The CME calendar matters not because you're going to memorize it, but because large open interest and option exposures concentrate around specific expiries. That concentration creates predictable stress points. When price approaches those zones, hedging flows can intensify. And when it happens into a thin open, the impact is magnified. That's why you can see these rotate fast moments where gold either rips higher in a burst or flushes and instantly rebounds. Those are not random. Those are the footprint of a market clearing imbalance under time pressure. Now let's translate all this into something actionable for your brain, not your brokerage account. Because the goal here is not to tell you what to buy. The goal is to keep you from being emotionally manipulated by volatility. Here's how the market will try to steal your position, if this thesis is right. First, it will punish late buyers with a sharp pullback right after a breakout, usually on a scary headline, not because the headline matters, but because it provides cover for a liquidity run. Second, it will whip back up when people give up, making the move feel unfair. That's how it gets you to chase high and sell low. Third, it will create fake certainty. You call, see loud voices telling you it S over or come at S going to $5,000 tomorrow. Both extremes are designed to make you abandon process. The antidote is a two-scenario lens and a checklist. Scenario 1 is the controlled pullback and retest. In this scenario, gold cools off, pulls back into that first support zone, and you see stabilization. Smaller candles, less follow-through on selling, and a quick reclaim of key intraday levels after dips. The curve and spreads stay relatively firm. The weekly opens stop gapping lower. That confirms the market is digesting, not breaking. Scenario 2 is the continuation squeeze with gap risk. In this scenario, gold doesn't give you the polite retest. It pushes, consolidates briefly, then breaks again, often at an open, because hedging flows and short covering feed each other. This is where you see air pockets upward. Price jumps through levels and the market has to reprice in a hurry. The risk here is obvious. If you're late, you're vulnerable to violent snapbacks. But if you're early and undisciplined, you can still get shaken out by the inevitable whipsaw. That's why you watch the tells, not the emotions. So what are the tells for the next 1 to 2 weeks? First tell, how gold behaves at the weekly open and at the major session handoffs. If gold is repeatedly finding bids early and holding gains into the US session, that's strength. If it spikes and then bleeds all day, that's distribution. Second tell, the dollar's reaction function. The dollar can bounce, of course it can, but does the bounce have follow-through, or does it fade quickly? A fading dollar rally while gold holds up is a classic sign that the regime is shifting. Third tell, the level that changes the math. In a market pressing new highs, that's usually the recent high itself and the round number above it. If gold convincingly clears the prior record zone and holds it, especially on a closing basis into the end of the week, that raises the odds of reflexive buying and forces hedges to chase. Fourth tell, pullback depth. In a healthy bull regime, pullbacks are sharp but shallow relative to the prior leg, and they get bought faster than people expect. If you start seeing pullbacks that slice through multiple support shelves without reclaiming, that's when you respect the possibility that something changed. Fifth tell, cross-market confirmation. If silver starts to accelerate while gold holds highs, that often signals broad precious metals participation, which can amplify moves. If silver lags badly while gold stalls, it can be a warning of narrowing breadth. And here's the quiet metric that often matters most, even though it's not glamorous, the spread and carry behavior around the front end. You don't need to compute it perfectly. You just need to notice if nearby pricing is acting too firm relative to the rest of the curve, because that's where paper versus physical tension tends to show up first. But that's not the part that matters. The part that matters is what participants are forced to do. Let's walk through the forced actions, because that's where audience trust actually gets built. If the dollar slides and gold pushes higher, exporters and importers adjust hedges. Corporate treasuries revisit risk buffers. Funds that are underweight gold relative to their new macro view have to decide whether to chase or wait. Some will chase because career risk is real. Meanwhile, shorts feel margin pressure because gold is a high notional market where a small percentage move is a big P&L swing. If volatility rises, leverage becomes expensive. If leverage becomes expensive, positions get trimmed. If positions get trimmed, the market can either flush or squeeze depending on who is forced first. This is why you can get a violent down candle in a bullish trend. It's not thesis broken. It's forced selling, meeting opportunistic buying. And that's why you must separate signal from noise. Signal is the market holding key zones, spreads staying firm, and opens not being sold into oblivion. Noise is intraday drama designed to make you feel. Now, let's talk about targets in a way that doesn't turn into fantasy. Targets are not promises. They're magnets and milestones. In a market already printing in the upper 4600s area, the next obvious magnet is the next big round number above. Psychology matters because positioning clusters there. If the market is in squeeze mode, you can see price probe toward that zone faster than people think because hedges and stops are concentrated around clean levels. But a realistic analyst always pairs targets with invalidation. Invalidation is the level where the market's behavior stops matching the story. If gold loses the breakout shelf and fails to reclaim it, especially if it closes the week below the prior support zone, that weakens the squeeze narrative and increases the odds that you in a longer digestion or a deeper correction. Again, that doesn't mean gold is dead. It means the near-term path changed. And near-term path is what you care about when attention is fragile and volatility is weaponized. So here's the near-term roadmap, clean and simple. Over the next week, watch the opens. Watch whether rallies are sold immediately or defended. Watch whether pullbacks stop at the first shelf or slice to the second. If gold holds the first shelf and starts making higher lows again, the market is likely setting up for another push into the highs, and the squeeze scenario stays alive. If gold loses that shelf and can't reclaim it quickly, expect chop, deeper retraces, and headline-driven whipsaws. Over the next 2 weeks, watch the calendar pressure points. Option expiry dynamics and month-end positioning pressures tend to intensify flow sensitivity. The market will try to bait you with certainty right when hedging flows are the real driver. Don't fall for it. Use the checklist. And remember, price can whip around violently even if the thesis is correct. That's not pessimism, that's professionalism. Now let me give you the punchline that ties the whole title together. The dollar slide is the visible story. The fast rotation in gold flows at the open is the invisible one. And the hidden detail, the thing mainstream commentary keeps missing, is that the curve and the hedging machine are what translate macro into price, especially in thin moments. That's why you can get a move that looks sudden. It isn't sudden, it's compressed. It is the market repricing a week as worth of adjustment into a few minutes because liquidity is thin and someone is forced. And if you want to be on the right side of that, you don't need a prophecy. You need a process. Here's your final checklist, the one you can carry into the next open without overthinking. 1. Does gold hold the most recent breakout zone on pullbacks, or does it lose it and stay below it? 2. Does the dollar's bounce have follow-through, or does it fade while gold stays firm? 3. Do you see open-driven strength that holds into the session, or do you see open spikes that get sold all day? 4. Do cross-market signals confirm silver participation, gold strength across currencies, or are they diverging? 5. Do the front-end pricing cues stay firm, suggesting urgency, or do they relax, suggesting the pressure is easing? If you can answer those 5 questions, you will be calmer than 90% of the market during the exact moments the market tries to steal your attention. And that calm is an edge. One more thing, because this matters for trust. You don't have to believe institutions are villains to respect institutional incentives. You don't have to believe in a grand plot to understand that balance sheets, hedges, and risk limits create predictable behavior under stress. The market doesn't need a conspiracy to be ruthless. It just needs participants to be leveraged and human. That's why the psychology shield matters. Expect the shakeout, expect the fake breakdown, expect the sudden reclaim. Expect volatility to be used against you. Then decide your horizon. Decide what level would actually tell you you're wrong. Decide what would confirm you're right. And let price do the talking. If you're here for mechanics over hype, you're part of the small group that actually survives these regimes long enough to benefit from them, not because you're smarter, but because you're harder to manipulate. Stay in that lane. Keep your eyes on the open, the shelves, and the curve cues. And if you want more of this kind of breakdown, fast, evidence-stacked, and brutally honest about what would invalidate it, stick with this community, because the next 2 weeks are exactly when these moves either get confirmed or they get used as a trap. And that's where the real pressure starts.